Hello friends, welcome to the February edition of Monthly Viewpoints. Equity markets continue to be volatile and range-bound. On the global front, the latest data on growth is encouraging. The US is likely to escape with a mild recession, Europe is expected to avoid a deep recession, and in China, the recovery is faster than expected. Hence, the IMF has upgraded the global GDP growth estimate to 2.9% year over year. In the US, the jobs data has come in stronger than expected. At the same time, wage growth is moderating. Hence, we saw that in the latest meeting, US Fed increased the policy rate by 25 basis points to 4.5%. Futures are now pricing in rate cuts by the end of the year. However, we believe that there is likely to be a prolonged pause by the Fed and we are not anticipating any rate cuts this year. In India, the focus was on the union budget announced on Feb 1st. The budget has ticked off all the major boxes: credible growth and tax estimates, no pre-poll populism, no tinkering with capital gains tax, record high capex allocation, reduction in fiscal deficit to 5.9% for FY24, and a commitment to the fiscal glide path. Overall, the focus was on infrastructure development with an increase in capex to 10 lakh crores. Also, the tax slabs have been changed and the tax rates reduced in the new tax regime, which should give some boost to consumption. Along with the fiscal numbers, the focus was also on the RBI policy meeting. Following the lead of the Fed, in its latest meeting, the RBI has increased its policy rate by 25 basis points to 6.5% and maintained its withdrawal of accommodation stance. There is a risk that we may see another rate hike in April before we see a prolonged pause by the RBI. While global equity markets have seen a rally this year, India has underperformed relatively. Hence, whereas earlier our valuations were on the higher side, currently the 1-year forward PE multiple for the Nifty is close to the long-term average. Even relative to the other emerging markets, the Nifty valuation is only at a 50% premium now compared to the long-term average of 40%. We continue to believe that the earnings growth estimates numbers should come in as expected at around 13 to 15% year over year. Given some moderation in valuations, we are expecting upside to be around 8 to 10% from equity markets this year. However, from a 3-year time frame, we continue to remain optimistic on Indian equities and believe that we can get a CAGR of about 13%. Hence, our recommendation continues to be that investors should maintain their equity exposure and think of adding lump sums on any market correction. From a 3-year point of view, the themes we are interested in continue to be banking and financial services, discretionary consumption, domestic manufacturing, and digital and tech. We provide a bouquet of funds for investors to choose from. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।